In today's video, we'd like to discuss the major upcoming central bank policy decisions. This week, we have 3 out of the 4 major central banks making their monetary policy decisions, that being the Bank of England, the US Federal Reserve, and the Bank of Japan. Last week, we already had the European Central Bank make their own interest rate decision, where they decided to keep interest rates unchanged at 3.75%. However, it is worth noting that the European Central Bank was the first out of the major central banks to cut interest rates, so it's already started its cutting cycle. So if we think about the Bank of England to begin with and discuss the dynamics and backdrop over here in the UK, we saw inflation moderate from the very elevated levels we saw in Q4 of 2022, peaking out at about 11%, where headline CPI inflation has fallen all the way to about 2% at the moment. However, what is giving the bank some trouble is where core inflation lies, which is much higher at 3.5%. And that's mostly being driven by the differences that we're seeing in services inflation and goods inflation, where services inflation is at 5.7%, and with goods inflation, that's actually in deflation, so we're seeing falling prices at a rate of negative 1.4%. Growth within the UK has picked up, so that's been a positive and moved us away from that technical recession scenario in the UK, but we know it's still sub 1%, so still fairly weak. So that would boost the Bank of England's hand in terms of looking to support growth, given where inflation's got to. So to provide some context around what markets are thinking, there's a roughly 60% probability being assigned that the bank looks to cut rates down to 5%, so one cut of 0.25%, and the market thinks that is about 60% chance. Come the end of the year, the market's thinking that we could see a roughly 2 rate cuts here in the UK, so that would leave us by year end at 4.75%. Now, if we pivot and start looking over at the States and think about what's happening in the US, we know that growth is also starting to slow more towards what we call a trend level or a long-term average of roughly 2%. And that's been driven by some of the dynamics we've seen post-COVID with the fiscal stimulus from the US government, which has helped support growth in the States. The inflation dynamic has also been improving. We know in Q1 of this year, we saw some higher, more sticky, elevated levels of inflation in the US, but the data since has showed us that that's more been driven by seasonality, and really what we've seen since is that the disinflation regime, so falling prices, has reasserted itself, which will be seen as a positive for the US Central Bank. What we've also seen is some weakness within the labour market. Now, we've seen the unemployment rate step up, but it's still at a historically low level, so more of a normalisation, and we've seen that also play through within wage inflation. So markets at the minute do not believe that we'll see a great probability of a rate cut in the US, roughly about 5%. That's mostly because the US Central Bank has been hinting towards no cut, waiting to see the data play out further before making their first move. And once again, for context, the market believes by year end we could see 2 to 3 rate cuts in the US. So that would take us from the 5.25 to 5.5 range in the US down to maybe 4.75, say, come year end. And then we go to the Bank of Japan, which is looking at much different backdrop and dynamics compared to the ECB, the BOE, and also the Fed. So in Japan, they've struggled in the post or pre-COVID regime to generate growth, generate inflation. But what we've seen post-COVID is that change. Japan's managed to generate growth and generate inflation. One of the things that the Bank of Japan have been talking quite a lot about was, though, making sure that inflation was done on a sustainable basis. And what we've seen since is that wage inflation has come through, which should help make that be more sustainable. The Japanese yen has been very weak over the past 18 months, and that's mainly due to interest rate differentials between markets. So the market believes that the Bank of Japan will want to stop inflation being imported through the FX channel, and as such believes there's a 70% chance that the Bank of Japan will increase interest rates, not cut, increase. But we have to think about where interest rates are in Japan. In December of last year, they did their first move out of negative interest rates. So in Japan, interest rates are 0%. So if we do see a hike, that will take us to 0.25%. So once again, policy is still very accommodative in Japan. And by year end, markets are thinking we could see another 2 to 3 rate hikes, so somewhere between 0.5% to 0.75% interest rates in Japan. As we've covered in previous videos, we're still within US earnings season, and to come this week, we've got some of the large tech names such as Amazon and Microsoft, and names that will be interesting to us as an investment team will be some of the consumer related names, so things like MasterCard, PayPal and McDonald's, which will provide us an update on the health of the consumer. So thank you very much for watching today's video, and continue to watch the YouTube channel for further updates this week.